I want to start out with kind of that big question that I teased a moment ago. As you look at the big indicators, jobs, GDP, is the economy weak or strong? What direction are we heading?
Can it be something in between that? It definitely isn't strong. It's not in recession, but it's not going anywhere fast and it doesn't feel very good for most Americans. I mean, I was listening to your monologue before I came on, and I think you kind of nailed it. If you look at GDP, gross domestic product, the value of all the things that we produce, that's growing. Not gangbusters, but it's growing, and it's somewhat disappointing in that it's growing below what economists call the economy's potential rate of growth. So it's not growing fast enough to absorb even the weakened labor force, and unemployment's moving higher. So it's growing, but it's kind of a fragile growth. And the thing that's really uncomfortable and bordering on disconcerting is that we're not creating any jobs. Job growth has flatlined since this time last year. Literally, I mean, you can look at the February employment figures. They're no higher. In fact, they're a little bit lower than they were back last April when President Trump had Liberation Day and raised tariffs. And the only sector of the economy that's adding jobs is healthcare. It's a big sector. It employs lots of folks, and you have hospitals in every community across the country, so I'll take it, but that's it. Every other industry is either adding a bit to jobs or losing jobs. The net of it's not going anywhere. So when an economy isn't creating any jobs and unemployment's inching higher, that's I guess the way I would think about it is we're growing, it's okay, but it's a very fragile and tenuous growth. Nothing else can go off script. And of course, as we can see, many things can go and are going off script with what's going on in the Middle East.
As we move later in the show, I want to ask you kind of one of my favorite economics questions, which is what's the one economic indicator that you watch most closely to read the tea leaves about where things are going? But I want to leave that in the parking lot for now.
Okay.
And I want to ask the more kind of immediate version of that, which is is going to make you decide right now that things are starting to turn south and you're seeing more weakness than strength?
I think the kind of the firewall between this uncomfortable, fragile economy that we have and something darker, a recession where we're losing jobs and unemployment's moving higher, are layoffs. So far, the weakness in the labor market, the job market, the fact that we're not creating any jobs goes back to no hiring. Businesses just simply aren't adding to payrolls. It's not like they're cutting payrolls. I mean, some companies are. You read about Block laying off 40% of its workforce, rumors that Meta is going to have big cuts. You can see other tech companies have been paring back, certain other industries. But in the broad scheme of things, we're not seeing we're not seeing any meaningful pickup in layoffs. And that's what I'm watching. If, in fact, for whatever reason, say consumers pull back because they have to pay more for gasoline and home heating and anything related to the run up in oil prices, and start laying off workers, then that firewall will come down and we'll go into recession. And again, we're in a pretty tenuous spot, very fragile spot. But I think that's the key to what we've got and something worse than that.
There's a debate spooling out right now about whether we're seeing the early warning signs of an AI induced like suppression of hiring. You mentioned that employers really aren't adding to payrolls. Maybe there's some uncertainty in that. I know that companies that I have worked for, the internal scuttlebutt is, gosh, we have AI tools. Like we could probably get AI to do this, or they're experimenting all the time. So when you read those tea leaves, do you think that's a factor? Do you think that's part of what's going on that's kind of restraining hiring? Or do you see it as more of a technology enabler of more productivity and more growth?
I think so far that the fact that we're not creating any jobs, I think AI, in the anticipation of what AI might mean for businesses, is probably on the list of reasons why businesses aren't hiring, but it's not at the top of the list. Certainly not yet. I think if you go back and look where job growth kind of went sideways, it was with Liberation Day back last April. I think it goes directly to the higher tariffs. We're losing jobs in manufacturing, which is a direct hit from the higher tariffs and the pullback in trade. We're losing jobs in anything agriculture related because the farm ag sector sells what it produces, a lot of it to the rest of the world, most notably China, and that's all been hammered. Transportation distribution, that's an industry obviously moves stuff around, and that's gotten hit hard. So that's the direct hit to jobs. Then you've got Doge cuts to government. So that's a couple, 300,000 jobs that have been reduced because of those cuts. And then I think broader, what I'd call uncertainty, anything related to policy, tariffs, immigration policy, heavy handed immigration policy, what's going on overseas. It feels like every month we're fighting another battle somewhere and a lot of drama. Businesses are having a hard time getting their mind around. And then, AI may be playing a role there. There's some academic research kind of connecting the dots between AI and the employment experience of younger people, particularly college educated in as you can imagine, the computer sciences or programming or customer support industries that would be most disrupted by AI. But that doesn't mean AI isn't going to play a much bigger role. And then that's another reason for a bit of angst here in 2026 is that, well, in fact, AI does kick into a much higher gear. Businesses do start to adopt, and they actually get to a point where they start laying off workers. And that's why, for example, I mentioned Block. Block is the fintech company that laid off 4,000 people, or is in the process of laying 4,000 people out of 10,000. And that's an industry you would expect to be disrupted by AI. And they're saying we are being disrupted. So that there may be other things going on there. There might be other reasons why they're laying off workers, but that's a tell that AI is coming on. So AI has played a role, but it's been a bit player. I think it's going to play a much bigger role going forward. And again, in a world where we're not creating any jobs with AI not being doing much of anything there, what does that mean going forward if AI really does kick into gear?
Just one more on the macro economy. There's a lot of chatter in kind of the chat community here about this disconnect between high prices, corporate profits, the fact that we may be in an AI bubble. We talked about the Mag 7 really fueling the rise in the stock market, the S&P 500. Is this a market bubble that's an opportunity for the crooks? As Lefty Gramps says, what about this disconnect between what one might call a fundamentals view of what should fuel stock growth? It doesn't seem like this is based on the fundamentals per se. It doesn't seem like it's based on the fact that there's been a lot of cheap money being pushed out by the Fed that has to go somewhere. So it's going into the stock market because that hasn't been the case in the last few years. Is this just like zombie mutual funds are just plugging ahead? Is the market just not reacting to real-time economic data? Why is there this disconnect? And is it a bubble that's going to pop?
The way I kind of would frame what you just said is that valuations in the stock market are very high. So if I look at the stock prices, and I compare that to the earnings of what businesses are generating, that's price earnings multiple, PE multiple, which is a measure of valuation. It's been higher in the past, but rarely. The last time was during the Y2K bubble, and that was a bubble when we saw the stock market suffer a big correction and a recession followed. We're in that territory, so I think it's a reasonable question to ask. And I don't know, I'm uncomfortable with the valuations. I'm uncomfortable with the fact that a lot of capital has come pouring in, both equity and debt, into the sector, and is resulting in a lot of investment spending, but a lot of kind of circular kind of investing in each other. So there's not a lot of transparency and all that. So that makes me uncomfortable. So I would say that there is a not inconsequential risk that we see the equity market correct, where we see prices come in and investors finally bring down prices more consistent with earnings. Now, having said that, it could very well be the case that investors are right. And this goes back to what we were just talking about. I mean, if investors are right that AI is going to come on big time and it is going to allow businesses to generate huge productivity gains, which is to their benefit, is going to result in more profits to those companies, including the AI companies themselves, then these valuations could be justified. It could be very well be the case that the stock market is fine, but the labor market isn't, that we see all these job losses occur because of the productivity gains that result from all the investment that's going on. So it's kind of a very tricky place. It goes back to the word I've been using, fragile. The economists would say in the most likely scenario, is this all going to work out reasonably well? Yes, valuations are high, but tech companies are going to be able to do just enough to support those valuations. And we're not going to see so much productivity growth so fast that we're not going to lose a lot of jobs, and the economy is going to make its way through reasonably well. But there's boulders on either side of that path. The one we talked about both of them. One is investors are right and there's going to be tremendous productivity gains, that of course means we're going to see more job losses than we would feel good about. It may be a problem, may not allow the economy to move forward in a graceful way. And the other is the one you were alluding to, the boulder on the other side is, oh, maybe investors have this dead wrong and we're not going to see those productivity gains. And if we don't, these valuations are too high and we are going to see a significant correction in stock prices and the result will be recession. So that's a long way of saying a boatload of uncertainty around all of this. The most likely is we kind of navigate through, make our way through reasonably well, but I don't say that with a lot of confidence. And that, just to end the thought, this goes right back to where we started. Why aren't businesses hiring? What I just said is a pretty good reason why you'd want to be cautious because of the uncertainty around this, and it's just impossible to know, exactly how this is going to play out.